Hey guys, I'm Duncan Wilson.
And I'm Sasha Syed, and you're listening to the Mortgage Sweet Spot Podcast, proudly presented to you by Mortgage Suite.
This podcast is your go-to source for expert insights, innovative strategies, and the latest mortgage trends to help you make the most informed decision regarding your mortgage financing. Whether you're a first-time home buyer, a seasoned real estate investor, or maybe somewhere in between, you've come to the right spot.
So sit back, relax, and get ready to discover your mortgage sweet spot.
Hey guys, welcome back to another edition of Mortgage Sweet Spot.
Mortgage Sweet Spot.
I hope you enjoy the new music that we possibly are going to change up on the intro.
This guy's killing me.
We wanted to go with a more classic approach, more upscale. So we're just looking for a different tune as you enter. And if you did hear it, you probably heard the new tune. Anyways, today, me and Sasha are in the office, taking our time to discuss what's called the HELOC. Some people call it a HELOC. Other people call it a home equity line of credit. I used to call it a secured personal line of credit, or an SPLC.
Well, most recently, we call it a home equity line of credit.
Yeah, we do. We call it, and if you watched the last episode, you would have realized that we were saying equity a little wrong in that video. So let's discuss HELOCs. And let's talk about the beautiful word reverse mortgage, because I feel like it's coming to the market so much more these days. Reverse mortgage, what is it? How does it work? Is there a reason to get it? And there is big reasons. So we're gonna look. Maybe today we'll do a comparison. Like, what's the difference between a HELOC? And if you don't know what a HELOC is, Sash.
Home equity line of credit, it's basically a line of credit that you're using the equity available in your property as a revolving line of credit instead of a personal line of credit. Cool things about that too is you get a little bit lower of a rate, and it's secured and it's to your property. So it's already your money. Typically easy to get, still have to qualify, but lots of different options for home equity line of credit.
If you just looked at Sasha's hand gestures, you should have understood what this whole thing is about. Okay.
Go get me a coffee cup. Or Ricky Bobby.
So you don't move your hands?
What do I do with my hands? Ricky Bobby.
I love it. So you can access, line of credits, typically max loan to value on those are 65. Is there some companies doing 80%?
Yeah, man. Are we allowed to name the lender?
Yeah, go ahead.
What's the credit union?
They'll just go beep.
Yeah, that Jim Mancuso came from?
That's right.
Yes.
They'll do 80% loan to value because they're a credit union. I think under the bank side, they can only go 65. But you can also have a portion, 15% of the full 80, which brings you up to 80. So 65 plus 15% equals total 80%. But that 15% has to be a mortgage portion.
Yeah, it goes into a fixed account,
Yeah, it goes into a fix. So let's look at an example of a $100,000 mortgage. You can have a $65,000 secured line of credit, personal secured line of credit, or a home equity line of credit up to 65%, then the other 15,000 would have to be a mortgage portion locked in. So that's kind of how HELOCs work. The portion that's the HELOC, interest only. So let's just discuss that. What's the advantages and disadvantages there, Sash, to a interest only payment?
So, I mean, the interest-only payment is going to work the same as your credit card, right? But I think with a home equity line of credit secured to your property, the interest rate's going to be a little bit lower. So you're talking about lower interest, a little bit easier to pay the balance down. You know, you're making those extra payments to pay the principal down. Whereas versus like your credit card's at like 20%. It takes forever to pay that down, right? You have to make big payments.
Yeah, so basically, advantage, you're paying interest only. Disadvantage, you're paying interest only.
Yeah.
That's one of the best situations you could be in. I mean, it's nil.
But focus on the lower part of the interest.
Yeah,
like on a home equity line of credit, you're probably like 7% right now.
Yep.
So imagine trying to pay down your balance of like 15 grand on 7% rather than 21 with a credit card. You can pay it down a lot faster. So
yeah. So I'm going to say you want freed up cash flow, but then for instance, let's look at maybe some people slowing down work, people retiring, things like that. If you looked at your returns on your investment side and your budget's looking pretty good, you might want to go with a secured line of credit instead of an actual traditional mortgage. That way you don't have to pay it down. If you're not worried about paying down the mortgage, you'd turn it into a HELOC and you'd ride out this interest. And yeah, you wouldn't pay any principal down, but your thoughts are you're possibly going to sell this house in the future anyways down the road, right? So all that is a secured line of credit. It's pretty cool. You don't have to touch your first mortgage a lot of times in order to get a secured line of credit against your home. So if you already owe the $15,000 first in this example of $100,000, we can go get you the 65, not touching your first mortgage term. So if you have 2.1% and you need access to equity, you're going to want a secured line of credit. All right. Now, let's move to a more, and I did touch on the whole retirement thing, right? Like people going to retire. There is this other option. And it is really hitting the market big time. A lot of people are taking advantage of it. The reason why is because a reverse mortgage, what I'm going to talk about now, is something that gets applied to the home. You could either be buying a house with this. You could actually refinance into this product. And what it does is it basically situates itself and goes on as a mortgage, but there's no payment. There's absolutely no payment. You can also look at, for instance, if you had never had a mortgage on your home, you could get a reverse mortgage that pays you from the equity of your home every month. So just quick two scenarios. Have you touched one in these days lately?
I haven't touched one yet, but what I understand is, like, for example, if your house has no mortgage, you can borrow up to 50% of the value. So just for number's sake, your home is worth $400,000. You can borrow up to $200,000 and you can get it paid out to you like monthly, or you can get it put in as like a line of credit where you can just access it anytime.
Correct.
So it's a pretty good option for, like, you know, older people that have that reduced income and living on pension, stuff like that. But what happens at the end? Like, what happens once that, because the exit strategy for that is for the borrower to pass away, right?
Correct. Borrower pass away or eventually move to a home. Personally, I mean, my mom and dad are moving in for me, so this product doesn't even make sense to them. But I would say your whole plan is they can either refinance into a traditional mortgage at the end of it. But the plan here is, guys, depending on if you go into a reverse mortgage when you're 65 years old, you ride this payment, let's say, or you ride this no payment, meaning payment to you, or you take $0 and just don't have a mortgage payment, you're going to last about 10 years, 15 years. So you're going to be hitting around 80 years old at that time. That's the plan you want to make. You do not want to go into a reverse mortgage where the thought is, okay, I'm going to do something in 3 years. This is kind of a plan to not think about your mortgage, maybe hit some vacation spots, maybe go on some cruises. Personally, I don't like cruises. Neither does my wife, because you're in a boat. And honestly, I grew up watching Poseidon with Russell Crowe. And honestly, scares the hell out of me. Anyway, so that's, guys, I implore you to, when you are redoing your mortgage at a later stage in life, really, really look at the reverse mortgage. The rates there, kind of comparable to a secured line of credit. Right now, I think you can get a secured line of credit at 5.75, roughly. With a reverse mortgage, you're probably looking upwards of 6.2%, maybe 6%, depending. Some of them are priced higher depending on the areas that you're living. But for the difference, okay, hear me out, for 1%, maybe 0.5% difference, you have no mortgage obligation. That's one of the kickers right there. You're lining it up and you're forgetting all about it, and you're going to go play golf. You're going to go on your cruise, like I said, the thing I don't like doing, or you go on vacation and just relax and don't worry about a mortgage.
Yeah, you don't have to make the payment. It's your equity is finally paying you out.
Yeah, so other than that, that's the difference between the beautiful HELOC versus this reverse mortgage. You got anything else to add, brother?
No, I mean, other than, like, you know, things that you can use your HELOC for, but we've done an episode on that, right?
I don't even know if we have. Touch on it quickly. List it.
Yeah, sure. Things you can use your HELOC for. You can use it for education. You can use it to start a business. You can use it to buy another property, right? As long as the ratios fit. You know, you can use it for investments if it makes sense. You use it for renovations. You can use it to go on vacation. You basically can use your equity for whatever you want as long as it makes sense.
That's 7 beautiful reasons right there, guys. I can come out and buy a car,
buy a boat,
kids' education, buy a boat.
I already said education.
Did you?
Yeah, so not going down there.
Education.
Yeah. You want to go back to school at 50? You can use your equity to do that. Nobody's telling you no.
That's right. So, guys, honestly, call Sasha. Sasha, throw your number.
519-919-1069.
Yeah, guys, if you guys need any questions asked, we're here not to take you on the phone call and kind of strap you in going, hey, you called me. Now I got you. No, it's more like, hey, thanks for calling. Let me give you some knowledge.
Yeah.
And honestly, a lot of times right now, guys, I have a clients, for instance, that coming up on renewal, and they're with a bank right now. And to be honest, all I do is kind of, yeah, I know it does boo, but honestly, sometimes these bank rates renewals are pretty damn good. Ugh. So my whole thing is,
yes, they are.
I would probably naturally tell you, I like least path of resistance, right? Like, let's take the least path of resistance. Path of least resistance. Thank you, Maddie. We're going to take that route. So when you call me, I'm more apt to probably say, hey, why don't you try your bank first for this secured line of credit? Because they can probably do it for free, and they should. Like, you're borrowing more money from them. Tell them to hook it up for free. And if they don't do it for free, you just give me a shout. Don't worry. I'll write a nice letter that we can do it for free.
I just told a client yesterday to go to his bank for his line of credit.
Because it just makes sense, guys. So try your bank first. They're good. They'll do a good job trying to hook you up. Now, if they don't, that's when I would like you to come to us, call Sasha, and we'll walk you through the process. In regards to a reverse mortgage, banks do not offer them. I don't know if they ever will. So we have a few actual lenders that do it on our side. We have and then those are two of the best ones I could see. There's a couple more out there, but really very niche product, and it's only offered by pretty much stellar lenders.
And one last thing about HELOCs too. It's not only just your bank or your A lenders that are doing HELOCs. If you do go to your bank and you get declined for any reason, come and see us, because we can do HELOCs with B lenders and with mix as well.
It's true, guys. Yep. It's true. You gotta remember that. And if you don't know what B lending is, episode 3, 2 minutes and 48 seconds in. Check it out. I'm probably wrong, but it's
it sounded so confident though.
Yeah, I know, right? Be very specific. Sorry, episode 4 minutes and 28 seconds in, correct? Yeah, that's the one.
Yeah.
So check it out, guys. It'll explain what the different types of borrowers are. But other than that, thanks for coming in and watching.
Thanks for checking us out. Give us a like, give us a share, tell your friends.
Please subscribe. Not to make us continue, because we're just going to continue.
Yeah, we're going to keep going one way or another.
We just like seeing you subscribe. But I like when people say, please subscribe to continue getting these videos. We're just going to continue doing them.
We don't do them.
We don't mind.
Smash that like button. Yeah. Smash it. Smash that like button.
And the share thing. The little arrow. The share arrow if you can. That'd be cool, guys. Get the knowledge out there, okay?
Yeah.
The knowledge and entertainment, okay? All right.
Stay classy, San Diego.
Yeah. All right, I gotta go find my book.
Ladies and gentlemen borrowers, thanks for tuning in to the Mortgage Sweet Spot. If you have any suggestions for upcoming episodes or questions for our hosts, me and Sasha, throw them in the comments below.
And if you enjoyed the podcast, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, or you can check us out on YouTube. Once again, thank you for tuning in, and we'll see you on the next one.